A couple things I just wanted to bring to your attention. Back in December of 2017, Economic Cycle Research made their announcement that their arrays that they've been watching for a few months are definitely turning, and we're turning down. And they had announced in 2016, right around the election time, that the U.S. economy and actually the global economy was going to enter into a period of what they called a cyclical upturn in a structural downturn. And they have announced that that's as good as it gets, that we probably have topped for the economy. So if you keep watching all the talking heads on all the business stations, why they just think the economy is just going to continue getting better and better and better. Not so, according to Economic Cycle Research Institute. And of course, that would mirror Martin Armstrong's forecast as well from Armstrong Economics, which also coincidentally, I mean, they use two different metrics, but they've came to the same conclusion. And lo and behold, we're starting to get data back. So we've already announced the fact that Wells Fargo has come out and said that their mortgage applications are the lowest level they've had since 2009. So that they're one of the biggest mortgage wholesalers in the country. We've also seen manufacturing starting to slow down. We just had capital goods ex-military slow down. We've had imports slow down. And the New York Fed has come out and said that they've had a pretty plunge in their metrics. It's surprising. No one expected that. And just the other day, I mean, literally just a few days ago, Richmond Fed came out, the Atlanta Fed, and said that business is slowing in that region as well. Some of the coincident indicators are also the Baltic Dry Index has dropped significantly. So one needs to be very, very aware of this. So we're getting into a good, strong cash position. We're trying to cut expenses. And keep this in mind. Now, this is, ad infinitum, we've been talking about the risk in the stock market. Well, the talking heads just expect this just to get better and better and better, which justifies higher and higher prices. But of course, if the economy is slowing down, that means profits are going to slow down. Business conditions are going to get weaker. And of course, we've had a lot of retail closings that have been in the news, which are another coincident indicator. So what I'm going to say to you is you need to be very, very aware of what's going on. Get yourself out of debt, cut expenses everywhere you can, and certainly start building up some reserves. Anyone who's in the stock or bond market really should start thinking of taking profits at this juncture. And if you need income, we can still get income in our favorite asset class, which remains our favorite asset class, which is real estate investing. And we can get a pretty good income, consistent and very conservative income for those that really need it. So if you're my age, we just can't afford to take too terribly much risk. Keep in mind that the average recession causes 39.6% destruction in an average portfolio. We're way beyond what probably will be average. So keep in mind, even taking a 40% hit on a portfolio is devastating when you're my age. So we need to be very, very, very conservative about this. So please, talk to your advisors, talk to your significant others. Just play the what if game. What if this really happens? What's going to happen to your portfolio? Talk to your advisor about an exit strategy and see what his thoughts are. And if there's anything that we possibly can, our email, my personal email address is down at the bottom of this, and you're welcome to email me, and I will help you any way I possibly can. So my very, very best to you, and God bless you.